So, what if you could get your stocks to pay you? Like collecting rent just for owning them? Well, that's exactly the idea behind a super popular strategy called a covered call. Now, it might sound a little technical, but trust me, the core concept is actually pretty straightforward. So let's jump right in and break down how you can turn your stock portfolio into a potential income machine.
All right, here's our game plan. First, we're going to cover the absolute basics. What exactly is a covered call? Then, we'll get right into the central trade-off, because there's always one. From there, we'll walk through 4 real-world scenarios so you can see the math in action. After that, we'll talk about how you can tweak the strategy for yourself, how to actually place the trade, and then we'll wrap it all up with the key takeaways you've got to remember. So let's start with section 1. What is a covered call? Well, at its heart, it's really just built on 2 very simple ingredients that work together to create that income stream we were talking about. Okay, so here it is in a nutshell. A covered call is where you take stock you already own, and you gotta have at least 100 shares, and you sell somebody else the right to buy that stock from you at a specific price within a set amount of time. And for selling them that right, you get paid a fee in cash right away. And that's the absolute key here. You're the one selling the option and collecting the cash, not buying it. Now that sounds pretty great, right? Getting paid right now? And it is. But like any strategy in the investing world, there's a trade-off. There's a give and a take. You are giving something up to get that guaranteed cash. So let's look at exactly what that is.
So here's the deal, plain and simple. On the good side, you get immediate cash, which is called a premium. This is guaranteed income, no questions asked. But on the bad side, the trade-off is that you're putting a ceiling on your potential profit. If that stock suddenly takes off like a rocket, well, you've already agreed to sell it at that lower preset price.
All right, theory is one thing, but let's make this really concrete. We're going to walk through 4 completely different outcomes using a real stock with real prices to see exactly how this whole thing works in practice.
Okay, so here's our setup. Let's imagine we own 100 shares of Intel, which we bought for $32 a share. We then decide to sell one call option contract. And remember, one contract always equals 100 shares. This contract expires in 2 months, and it gives the buyer the right to buy our shares from us for $34. Just for making this agreement, we are immediately paid $1.50 per share. So boom, that's $150 in cash deposited right into our brokerage account.
Okay, scenario number 1. The stock goes down. Bummer. Intel drops to $30. Well, think about it. The person who bought our option isn't going to pay $34 for our shares when they can just buy them on the open market for $30. So the option expires worthless. Now, we lost $2 a share on the stock itself, but we got to keep that $1.50 premium. That acts like a cushion. So instead of being down $2, we're only down 50 cents. Not great, but better. What about scenario 2? The stock goes absolutely nowhere. After 2 months, it's still sitting right at $32. Again, the option expires worthless, and we keep our shares. We didn't make or lose a dime on the stock, but we still have that $1.50 premium in our pocket. We literally just made a profit on a stock that did nothing. Now, just pause on that for a second. Making $1.50 on a $32 stock, that's a 4.6% return in just 2 months. If you could pull that off again and again all year, you're looking at an annualized return of almost 28% on a stock that went absolutely nowhere. I mean, that's the power of this strategy when the market is just treading water. Okay, what if the stock actually goes up a bit? Let's say in scenario 3, Intel's price rises to $33. Since that's still below our $34 sale price, the option expires worthless and we keep our shares. Now, this is a fantastic outcome. Why? Because we get to profit twice. We've got a $1 gain on the stock itself, plus we keep that $1.50 premium. That's a total win of $2.50 per share. And the return here? It's even better. That's a 7.8% gain in just 2 months. If you annualize that, you're looking at a massive 46.8% return. This right here, this is really the sweet spot for a covered call strategy. And finally, scenario 4. The stock goes to the moon. It shoots all the way up to $40. Now the person who bought your call option is definitely going to use it. They're going to exercise their right to buy your shares at that agreed upon $34 price, so you're forced to sell. You still made $2 per share from the stock's gain, plus you keep the $1.50 premium. Your total profit is a solid $3.50 a share. You made good money. but you missed out on all those gains between $34 and $40. This is that core trade-off in action. But here's the real kicker. Even in this scenario, where you left money on the table, you still walked away with an 11% return in 2 months. Annualized, that is a staggering 66% return. So your so-called worst outcome is still a fantastic gain by almost any measure you can think of. Okay, so now that you get the mechanics, let's look at the 2 main levers you can pull to really tailor this strategy to fit your own goals and what you think is going to happen with the stock.
First up is duration, which is just the expiration date. A shorter-term option, like our 2-month example, will give you a smaller premium upfront, but it gives you more flexibility to kind of reset your strategy every couple of months. On the other hand, a longer-term option, maybe 6 months out, will pay you a much fatter premium today, locking in that income, but also locking you into that deal for a lot longer.
The second big variable is that strike price. Picking a price that's really close to the current stock price will get you a higher premium, but it also means it's more likely you'll have to sell your shares. If you pick a strike price that's further away, you'll get less cash today, but you give your stock more room to run up before those gains get capped. And volatility plays a big role here too. A stock that swings around a lot will pay you a way higher premium than a slow, steady one. So you really have to ask yourself, do I want more guaranteed cash now or more potential for growth later? Okay, we've covered the theory, we've talked about the strategy. So how do you actually do this? Let's just walk through the simple step-by-step process for placing this trade in your brokerage account. It's really just a 5-step process. First, and this is the most important rule, you have to own at least 100 shares of a stock you're actually happy to hold for the long haul. Second, in your brokerage account, you navigate to the options trading screen for that stock. Third, you're going to choose the command Sell to Open for a call option. From there, you just pick your expiration date and strike price from the menu, enter how many contracts you want to sell, and hit Submit. That premium cash shows up in your account almost instantly. It's that fast. And the best part is what happens next, which is nothing. You don't have to do a thing. If the stock is below your strike price when the contract expires, the option just disappears. Poof, gone. If it's above the strike price, your broker automatically sells your 100 shares for you. The whole thing is handled behind the scenes. Wow, okay, we have covered a lot of ground. So let's wrap this up by boiling it all down to the absolute most important points you need to take away from all this.
So here's what you need to remember. Covered calls are first and foremost an income strategy. You get guaranteed cash up front, but in exchange, you cap your stock's upside potential. The amount of cash you get depends on time, the strike price you pick, and the stock's volatility. The whole process is easy and automated by your broker. And finally, and I can't say this enough, only do this on high-quality stocks you'd be perfectly happy to own for years to come. And all of this brings us to the final and maybe the most crucial question you have to ask yourself. Let's go back to that last scenario where Intel shot up to $40. You made an 11% return in 2 months, which is a home run by any standard. But you could have made more. So would you be happy with that fantastic, predictable gain? Or would you be kicking yourself for missing out on the bigger, unpredictable one? Your answer to that single question will tell you everything you need to know about whether covered calls are the right strategy for you.